Hello, everyone. Logan Hertz here with Hazeltine LLC. We have back with us a returning guest. This is Harrison George of CMG Financial Home Loans. They have a product we're talking about, among other products, but the one we're going to be talking about today is a First Lien HELOC product known as the All-in-One Loan, which dates back from 2006. We're going to talk about what it is, why would someone want to use it, what are some of the real life success stories we've been seeing? Harrison, good to have you with us today. How are you doing?
I'm good, Logan. Thank you. Appreciate you having me on again.
Absolutely, absolutely. So, why don't you start with the basics, Harrison? Maybe introduce yourself a little bit more if there's anything else about your
Yeah.
background you want to share. And then just give us the basics. What is the all in one loan?
Yeah. So obviously, I'm Harrison George. I work at a mortgage company called CMG Home Loans. We're the largest privately held mortgage company in the United States. We have about 4,000 employees. We do residential financing currently, not just this all in one first lien HELOC, but we do conventional FHA, VA, and so on, and a bunch of non traditional products. The company that I work for was obviously called CMG. And one of the products that we focus on, at least my team and I, and a large portion of the company is starting to really gear up towards learning about this product, is this first lien HELOC.
Yeah. So, the first lien HELOC is no branded as the all in one loan. So, let's assume no knowledge. What is it
Okay.
and why would anyone want to use it?
Perfect. So I'm going to take a few steps back and then I'm going to provide some education into it. Let's first talk about the 30-year mortgage. The 30-year mortgage is a phenomenal product. And this is not me speaking down on a 30-year mortgage. It helps millions of people get into homes or buy real estate every single year. Now, that product is not always going to be the best solution for the consumer in terms of interest expense. The 30-year mortgage bases its payment off of what you borrow in day one, hour one. If it's a $400,000 loan, your mortgage payment is split into four pieces: your principal and interest, and your taxes and insurance. The principal and interest in a 30-year mortgage always adds up to the same number. Starts high with interest and low with principal. Over time, that starts to switch where the principal increases and interest decreases. You don't see that X take place until 14, 15, 16, 17 years into the loan, but you've spent a lion's share of the interest already. In fact, in the first 5 years of a mortgage product, you spend about 25 to 28% of total interest. All in one loan is flipping that on its head. And I'm sure many of you guys are familiar with a credit card. So I'm going to use a credit card example to get into what the all in one is. If you have a credit card with a line of credit of $10,000 and you owe $4,000, your payment is based off of the $4,000. But the individual still has another $6,000 that they can use for something else. Now, the cool thing is that if you put money into the credit card and the balance goes down, then your payment is now calculated off of a lower balance. Conceptually, that's exactly like the all-in-one loan, except it's at a much larger scale. So the all-in-one loan is the first position home equity line of credit. And this is paired with a checking and savings account. Just like you have at Wells Fargo or whoever you bank with, your money goes into and comes out of. Into when you earn money, out of when you pay your credit card bills, your gas, electricity, diapers, groceries, whatever it is that you need to spend money on. Now, this product has a combination between the checking and the HELOC. As you earn money into the checking account, it sweeps automatically into your mortgage balance. After your balance goes down, it's calculating the payment on a daily basis. Everyone always says your average daily balance. No, no, no. It's 11:59. Any money in your checking account sweeps into your mortgage, and your payment is now calculated at midnight. This person that has this first lien HELOC on a primary residence gets a line of credit of 80% of the value of their home. For easy math, they have $1 million home, they get a line of credit of $800,000. If they owe 500 grand, right out of the gate, they have access to that $300,000 that they can do whatever they want with. They can invest it into real estate. They can go to Vegas and put 100 grand on black if they want. Obviously, I don't recommend doing that unless you have an in. But at the end of the day, when you have a balance of 500,000, your payment's calculated off of 500. So if you have 100 grand sitting in a money market making you 3%, you could, and likely I would recommend taking that and moving it to your mortgage balance, paying it down to 400 grand, because the rate on this program in November is between 6.7 and 8.2. So a penny saved is like a penny earned. Would I rather earn 3% over here, and you do have to pay some form of expenditures like taxes on this money market interest you gain, or would I rather offset 7.5% over here, where every dollar I don't spend is not subject to another form of tax? I mean, that money is staying in my pocket. So I'm actually earning that 7.5%. Now, I get it. 7.5% is probably higher than the loan that you're in right now. And going back to that 30-year mortgage, well, I'm in a 4% or I'm in a 5%. Sure, you're in a 4 or 5%, but the total amount of interest you pay is much more than 4%. You're looking at like 80% of what you borrow in interest. Whereas this loan, as that balance goes down and you build up the equity until you need to deploy it, your payment's going down with it, meaning you're saving more money monthly. And as you save more money monthly, you pay off the home much quicker. And then you have access to more money that you can go and put into new, I call them engines. Go buy another rental property. I use 100 grand to buy a rental property. That new rental property is bringing me income, plus my income's coming in. Once you build up enough equity, go buy another rental property. Now I have 2 engines plus me. And if you rinse and repeat that enough times and you start growing more and more real estate or income generating properties or items, then realistically, you can start saying, hey, maybe I can have my significant other stop working or slow down, or maybe they can start that business, or maybe I can start that business to go to that next step, to my goals, building that generational wealth. And this program gives you the ability to reach into the walls of your home, take that equity and deploy it. But while you're not using it, it's still working for you. Whereas a 30-year mortgage, once it's in there, it's gone. You can't touch it.
Yeah, there's a couple of keys to it. You didn't mention the phrase, but the strategy we're talking about here is known as velocity banking. So let's be
Yes.
clear that the all-in-one loan is a first lien HELOC, and it only makes sense if you are doing velocity banking. A lot of people will make an unfair comparison between the mortgage and the first lien HELOC because they don't understand how the first lien HELOC is intended to be used. So if you're making no extra payments on the first lien HELOC, this is not a good idea. That's not how this works. The idea is because a HELOC is a two-way street, whereas a mortgage is a one-way street. You pay money into it, but you can't pull money back out. Because a HELOC is a two-way street, we can use it like a checking account, and that's exactly what we're doing automatically.
Mm-hmm.
The checking account is linked to your HELOC. So automatically you are running your cash flow through your house, through your home equity. So because of that, the balance is going down quickly because what was deposited into a checking account tomorrow is a payment to your loan balance today. And you can pull money back and forth. Velocity banking is the strategy. The all-in-one loan is one of the tools that can be used for velocity banking. And this would get you access to, as you mentioned, 80% of the value of your house minus whatever you still owe on
And
that
that's on a
loan.
primary. This can be done on second homes and investments. It can also be done as purchases and refinances.
Correct.
And that's between 1 and 4 units. So if somebody said, hey, I have a 4-unit rental property, I owe X, the value is this, then that will give you between 70 and 75%. And there's some other calculations, and we can chat with people about it.
Correct. And I always hesitate to throw out numbers because these things change all the time. People will yell at me because we said something 5 years ago and the interest rate is different than it was 5 years ago. Well, of course it is.
Shocker, shocker.
If you compare a mortgage today to a first lien HELOC today, the interest rate on the first lien HELOC will be higher. That's why this only makes sense if you are doing velocity banking. It's more about cash flow efficiency.
Exactly.
So it's a much more flexible tool than a mortgage. Again, nothing wrong with a mortgage, nothing wrong with paying cash for a house. So a 30-year mortgage certainly has its uses. And if you talk to myself or Harrison, we're going to vet you a little bit, work through your scenario to make sure that this product makes sense for you because it does not make sense for everybody. Some people should use a mortgage, and there's nothing wrong with that. This product has been around since 2006, so we've gotten the opportunity to see a lot of people succeed with this all-in-one loan. And it's not just about paying off your house or paying off debt, which, by the way, you can do that. You can refinance other debts into your all-in-one loan. That can be a great solution. But how personally have you, Harrison, because I know you are a product of the product, you were doing this today. How personally have
Yeah.
you used your all-in-one loan to get ahead financially?
I use it quite often, obviously every single day. when I pay my bills and earn money. I have personally utilized this. So my wife and I have paid down the balance of our mortgage, and we're just looking at the arbitrage difference. Our interest rate is X. If I lend out 100 grand and I'm able to make Y, the difference is what I'm going to earn. So for example, let's just use 7.5%. So there was an opportunity where I was actually able to do a hard money loan for a friend of mine who I've done a hard money loan for in the past. And I am charging him 17% on the money that I lent him. And simultaneously, my rate is costing me 7.5%. So the difference between those two is what I'm making. I'm making my original interest expense back when he pays the loan off, plus the original principal that I've lent him, and then all the extra interest. Now, yes, there's going to be taxes, so it's not an exact spread of the 17 and 7.5, but it's still something that we've done. There's been plenty of opportunities with builders that we've worked with, because obviously I do loans and I talk to builders. But even more than that, there's been an opportunity where bought a property and we paid, it was one of those, dilapidated pieces of property over on the East Coast. We essentially were able to pay for it cash, renovate the property. And then after the required amount of time, we were able to refinance the property, pulling almost all of our purchase and renovation costs out, because the value, we bought it for like 60, put in like 35 or 40, and the appraised value of the property came back at like 150. We put a renter in that property. We pulled back our approximate $100,000 and put it back into our all-in-one. And then simultaneously, we're receiving rental income that's now paying down this new mortgage, which is fine. And once you start doing 2 or 3 of those, we're now going to say, great. If that person generates $500 in cash flow and we do 5 or 10 of those, you could see how that massive amount of, I guess, the quantity of the income in relatively small chunks can start working at paying down that mortgage further and further every single month, so that we can just do another one. Clearly, at some point, the goal is to, for my wife and I, it's, hey, let's buy properties. Let's have there be finance products on them. Make sure that we have a large enough spread, even that if that means money's not coming back into our pocket. And then maybe in 10, 15, 20 years, we'll start working on paying off those debts. But let's first start accumulating those rental properties so that we can weather any storm. If 2 or 3 or 5 of them didn't have renters in it, we still have kind of an emergency fund sitting in our all-in-one, but we're just letting our money work for us above and beyond just sitting against the balance of our home.
Right, right. So it sounds like what you're doing is somewhat similar to what Greg Faricelli, who I've had on my show as a real estate investor, is doing, where he's doing the velocity banking strategy. He's feeding his income into his first lien HELOC. As the
Yep.
balance comes down to a point where he's comfortable with it, now he doesn't want his capital. It's not sitting idle, obviously. It's not idle because it's working for him, but he wants to pull that out, go make a property purchase, let's say it's a rental property, and then feed the income from that investment back into his first lien HELOC, plus all of his regular income. So then he just replenishes his borrowing capacity and pulls it right back out again and rinses and repeat. And that can be a great way to acquire 3, 4, 5 cash flowing properties. And, having 5 cash flowing properties, that can be game changing for a lot of people.
Oh yeah,
And I think one of the
totally.
benefits
I mean,
here is you did not have to go ask the permission of a bank to finance each one of those properties. Well, depending on how you do it. You could use
yeah,
your first lien HELOC to just make the down payment and finance that subsequent property with a conventional mortgage or a first lien HELOC. You could do that too. You can stack them. But I think what most people are doing is they're actually now coming in as a cash buyer. So you're getting the best of both worlds. You're going to buy a property from the perspective of the seller, you're paying cash.
Mhm.
You're pulling $200,000 from your HELOC and you're paying cash. But from your perspective, you actually financed it because you used the line of credit against your house, but you get a better price because you're coming in with a cash buyer. You don't have to wait for a
Yeah,
bank's permission and go through any of those headaches. So now you have total control all the way through. And then you can start repaying that HELOC back into your property, your primary residence. And then once you've replenished your borrowing capacity, you can go and rinse and repeat the process, right?
exactly. I mean, that's kind of exactly what we've seen a lot of people do. They find a property, maybe it's for sale for 250. They offer them 220. They get a little bit of a deal because, hey, I'll close next week. They then buy the property. There are some guidelines of waiting a certain amount of time after you purchase a property to pull cash out at the appraised value, not the purchase price. So after about 6 months, you can then do a refinance on the value of the property. So if the value of the property is 250, great. I bring in $2,000 a month. I don't want my mortgage payment more than $1,500 a month. You can then just say, great, I want to pull out to the point of where my mortgage payment with everything included is $1,500 so that I have this cash flow. That might not allow for you to get all of it out, but it does allow for you to say, hey, look, I don't want the money to be locked in that other home. I'm going to take it, put it back into my all-in-one so I can go and do another property, find it a little quicker and build that portfolio a little faster.
Yeah, and let's talk. This is maybe a bit off the beaten path, but I do have people who come to me who have their primary home and they have real estate investments as well. And they have this idea in their head that I just cannot shake them out of. They're very rigid in it that, no, I don't want to do the all in one loan on my primary residence. I want to do it on one of my investment properties or a second home.
It
And I'm trying to explain to them, actually, no, that's actually
doesn't matter.
higher risk. You don't want to do that. I mean, it might make sense in some scenarios, but generally
Certainly.
speaking, the big time real estate investors I work with who understand this strategy, they're doing the all in one loan on their primary residence. So explain why. Let's say I'm a real estate investor and I have my primary residence and 5 rental properties. All of them have mortgages, but with a fair amount of equity in them. Why would I want to do the first lien HELOC on my primary residence and not on one of the investment properties?
Well, there's a couple reasons just from my side. So one, in many instances, most people's highest value property is going to be their primary residence. So if they say, oh, I have a $100,000 property over here and oh, I owe 50 grand on it, you can only go to 70% on that. So you're only getting a line of credit of 70,000. So even if you paid it down, you're still probably not going to be able to buy that next property. Also, my thought is if you're going to borrow money, if you're going to have debt, why not pick the cheapest debt option there is and have it sit on your primary residence? So not only are you able to likely get the highest line of credit because it goes to 80%, but you're also choosing one of the options that's the cheapest to obtain, which means then your cash flow and your rate of return is going to be slightly higher than if you chose to be on a different property. So those are two of the largest options of individuals. I mean, you could go into other, hey, there's safety and security options of being on my primary and not having to worry about this tenant in the property tripping and suing and so on and so forth.
Right, because I think
Um,
I think again, I think it's an emotional decision because people somehow think if I have the loan on a different property other than my primary residence, somehow that's safer. If you think it through, that's actually the opposite of the case. It's actually lower risk and safer to have it on your primary residence, right? Because I'm in control of my primary property. I don't have a tenant on it. It's me taking care of that property, right? And
correct.
and a lot of people have this idea that, well, if something goes wrong on that investment property, then it's somehow limited, secluded to that investment property, and it's an isolated problem. The bank cannot come after me. Oh, yes, they can. Yes, they can come after you, even if that's like its own LLC. Unless you got into the sort of scale where you can well and truly have a C corp and well and truly be separated from it. Don't think that if you have the all-in-one loan or any bank loan on an investment property, not on your primary residence, that somehow it can't come back on you if things go wrong, right?
Yeah, correct.
So even if people think I have this other investment property, it's in an LLC, that doesn't matter. If something goes south on that investment property and you're struggling or you default on that loan, that they absolutely can come after your primary residence, right? Anything there's no wall of separation there that's going to protect you. So I want
That's right.
people to understand you got it. That's just an emotional decision. I'm not saying it never makes sense to do the all-in-one loan or a first lien HELOC on a investment property or a second property. But almost always, if you don't have one on your primary residence, that's almost always the right place to start.
It's a good place to start. 100% agree. I mean, because here's an example to kind of to play the other side. If your primary residence is 800,000 and you just bought it and you owe 750 on it, okay, probably doesn't make sense to do it on your primary. If you have a $400,000 rental property that's free and clear, sure, the total line of credit you get on your primary would certainly be higher, but you don't have the access rate out of the gate.
Mhm. Yeah, yeah, and then it gets interesting too, where you can do more advanced strategies where you're mixing and matching on these different properties. But the other benefit I think that real estate investors understand more is the fact that I don't need the permission of a bank to use my first lien HELOC. So I'm sure you come across this all the time, Harrison. I know I do, where real estate investors cannot qualify for loans despite the fact that they have lots of income and lots of assets because on paper they show very little income. That's why they pay no taxes. That's a great
Yeah.
benefit to being a real estate investor, but it becomes a problem when you want to try and finance properties. And I hear from real estate investors all the time, I know I can buy these deals. I know they're good money makers for me, but I cannot get the financing, right? If you qualify for a first lien HELOC in your primary residence, then for the next 30 years in this case, granted there's a caveat to that, but there's a draw period of 30 years where I don't need a bank's permission. I have the capital already available to me. I can pull it anytime I want, right?
Yeah. And then, as long as you can show income to qualify for the first lien on your primary, then those subsequent years, you can start saying, hey, look, I'm going to write off more to,
Right.
be
Right.
phenomenal with my taxable
Right,
events.
right.
And
It's a
then that
one-time
will,
thing. Yeah, so
yeah,
oftentimes I'll do this scenario, and I think we've done it together, Harrison, where we talk to a real estate investor and say, okay, in order for you to qualify for the all-in-one loan, you have to show this much income. Talk to your CPA, and he'll tell you that means you're going to take this much of a tax hit, but it's going to be a one-time hit because then next year, when after you qualified, then you can take all the deductions you want next year. So is it worth paying an extra $20,000 in taxes one time to get access to this phenomenal debt instrument? In almost every case, the answer is yes, because now I
yeah,
know I can buy 10 properties subsequently that are going to get me way more cash flow than that, right?
certainly. And obviously, I'm not a CPA. I can just say, hey, look, if your income's here for you to qualify, you have to be here. We're by no means saying, hey, look, this is how you have to do it on your
Right,
side. Talk
right,
to your CPA
right,
clearly.
right. We're not giving tax advice. That's where your CPA will tell you how much income, or Harrison will tell you, I won't, how much income you need to show. And then your CPA will tell you, and then here's how much taxes you're going to pay as a result. And you can decide, is that worth it? And this is where we can help clients. We can show you precisely what you need to do in order to qualify. So even if you don't qualify today, it can be worth a conversation to see, okay, what would I need to do in order to qualify? Which, by the way, that's one thing we should mention. All in one loans are not the easiest thing to qualify for. So I think a lot of people, when they're getting into financial topics like this, they treat everything as something they can have anytime they want. Like it's just buying a cup of coffee.
Of course.
The people who most jump on to some of these alternate strategies that I teach, like the infinite banking concept, which uses cash value life insurance. The reason why they do it is because they know these other financing solutions are hard to get access to and you cannot get it anytime you want. So when I have capital in my cash value life insurance policy, I know I can take out a policy loan on a guaranteed basis, right?
Mhm.
So the people who say, well, I could just borrow against my house or I can just borrow against my investment account. Yeah, in theory, you can. In theory, you
Yeah,
can. But especially if you want to do that at scale, good luck with that. If you want to try and scale that up and you're not a big time, high net worth professional investor, you will never be able to do that at scale. Yeah, if you have a W-2 job and you want to borrow against your primary residence, yeah, that's probably not too difficult, right? But if you want to try and scale that and really start doing the buy, borrow, die strategy, you're not going to be able to qualify. It's just not going to happen, you know?
correct. And even more importantly, in my opinion, and above and beyond the real estate investing, is that there's a sense of security, in my opinion. In that scenario where that person had an $800,000 line of credit and they owe 500,000, well, what happens if something happens? I mean, to prepare for something that you don't know what to prepare for, or job loss, loss of a family member, loss of income of a significant other, or so on. In a 30-year mortgage, if you don't have money left over on the side, or if you do have some money left over on the side, it's a relatively finite source. That balance is going to go down. And once you don't have extra money in the account, you can't go and make that mortgage payment. Well, if you have this buffer of equity in your home, and you're able to live out of it, yeah, your expenses are going to go down because you're not bringing in as much money. You're probably not going to go to the movies that once a week or whatnot. But that balance, you have so much extra room, wiggle room to weather a storm. And that's really the most important part, in my opinion, about this. Not only do I get to use the money to deploy it, increase my income in the household, but if I ever ran into an emergency, I still have this buffer over here.
Right. And that's where I agree with you. And that's why this strategy requires financial discipline. It's a double-edged sword.
Exactly.
Access to all this extra liquidity is great if you can be financially responsible. If you're going to be tempted to pull that money and spend it on stupid consumer stuff, then this is going to work against you. Now, those sorts of
Yeah, I
people
wouldn't recommend
probably
that.
won't be able to qualify to begin with, so it might be a bit of an academic point. But that's why there is a vetting process that includes not just a mortgage loan officer, but a financial professional like me, so we can bring someone to the table and, hey, this is not as easy to qualify for as a mortgage, and it requires a higher level of financial education and financial discipline, right?
Mm.
We're giving you an extra tool that used appropriately can really be amazing, but used inappropriately can work against you, right? If
Exactly.
you're not running your cash flow through this like you should, which I'm always surprised by the number of people who they're all about wanting to do this strategy and they don't seem to understand that no, you need to be running all your cash flow through this for this
Yes.
strategy to make sense, right? It's not just your standard HELOC. That brings me to a subsequent question because for more sophisticated types, the question we oftentimes are looking is what makes more sense? Should we do something like the all-in-one loan or should we keep our mortgage and just do a second position HELOC? Because some of these things you can do with a second lien HELOC, not all of it. So how would you help someone walk through that decision? Should I just get a second position HELOC or does the full all-in-one loan strategy make more sense for me?
And my answer is really going to be it kind of depends
Of course,
on
yeah, it
your
depends.
individual specific scenario. In
Yeah.
many instances, some people that have a 2% 30-year mortgage can go into this all-in-one loan and actually see a benefit of utilizing this all-in-one loan. Now, there are other individuals who go, hey, look, I'm in a 2% mortgage, but I'm only saving $150 or $200 a month. Well, then in many instances, it may not make sense to do a first position and to do a second position because those people that are probably only saving $100 or $200 a month, maybe have some other debt on the side. Let's work on paying that debt off. Let's use the money that we're now positively cash flowing to then pay the line of credit off and either use that to go and buy more real estate or not buy more real estate. But really, it's just going to be let's run a math problem. And that's all it is. It's not like we're doing this crazy, voodoo over here with
Right.
tarot cards or something. We're just essentially saying, hey, look, my income is X, my debts are this. This is how much I save every month right now. If we paid these off, then I'm going to save a couple extra bucks. As long as you have enough equity in the home and you're saving enough money, I would say, hey, let's look into this first position HELOC.
Yeah, yeah. I think that if we could contrast the pros and cons, first of all, when people hear HELOC, unfortunately, I think a lot of people think they know what we're talking about when really they don't because it's not just any HELOC, it's a specific strategy. It's really velocity banking is
Yes.
what we're talking about.
Yes.
And so then people get wrapped up in mortgage versus HELOC, which in my opinion just completely misses the point. It's about the strategy. It's about your
Mhm.
personal financial situation, what makes the most sense for you. Mortgages are perfectly fine. HELOCs, second position HELOCs are different from what we're talking about. So if I were to compare and contrast the two, I'd say one of the advantages of the all-in-one loan is automation. So the velocity banking strategy is automated. You have a checking account with a sweep feature that's automatically linked to your HELOC. So all this happens automatically behind the scenes. That's a big advantage. So you're doing it with maximum efficiency. And there's a psychological benefit that you don't have to really take any extra steps, right? You're just managing your cash flow like before, but behind the scenes, all this is happening automatically. You get access to more equity than a second position HELOC would, and significantly more equity. And as you pay that balance down, that equity amount that you have access to increases, right? Whereas with a second position HELOC, you're limited to whatever the line of credit is. If you have a mortgage, as you pay down that mortgage, your line of credit doesn't increase
Stays the
automatically,
same.
right? The interest rate will be lower on a first lien versus
Mhm.
second lien HELOC because obviously the bank is in a better position and you eliminate escrow, right? So now there's benefits to that where you can actually, pay those at the end of the year instead of upfront. And you can use rewards earning credit cards to pay them. And in some cases, you can get discounts for paying them in advance in a chunk. So those are some of those benefits there. I think the drawbacks would be now you really have to be doing velocity banking if you're going to do the all-in-one loan.
Yes.
If you have a second lien HELOC, if all you really want is access to liquidity, a second lien HELOC will give you that to a certain extent. Not as much, but it'll give you
Exactly.
liquidity and you don't have to be doing velocity banking. If you just want access to the equity in your home, but you're not thrilled about running your cash flow through it, or maybe that doesn't make sense in your cash flow situation, a second lien HELOC can do that for you. It can give you access to it. It's easier to qualify for, right? A second lien HELOC is easier to qualify for than a first lien HELOC. Typically, the interest rate will be higher, but there might be no closing costs, right? If you want to do a first lien HELOC, there are typically going to be more transactional costs because it is more like, it's not the same, but it's more like taking out a mortgage where there's going to be closing costs. Whereas with some lenders, you can do a second lien HELOC with no closing costs, right? So
Right.
and then if you're one of those people who has a super low interest rate mortgage, you don't want to refinance out of it, but you do want access to the equity in your house, well then that second lien HELOC could potentially become a better option as well. So how would you advise someone who's looking into this strategy? Maybe they're sort of at the beginning of their educational process. How would you advise them to move forward and decide if this is right for them or not?
Yeah, I mean, I think the first place to start is take a look at your actual income and expenditures. Take a look at, hey, what do I make monthly? How much am I saving monthly? There's been plenty of times where we hear, hey, I make $10,000 a month and I save $4,000 a month. But then we look at them because we have to see the whole profile. We have to see that they qualify everywhere, not just in one spot. And if that person says, well, I don't have any money in my checking and savings account, then in reality, you're not saving $4,000 a month. You're saving $0 a month. So do a deep dive in your specific scenario. If it's, hey, I could save $4,000 a month if I paid off all this high interest rate credit card debt, because right now I'm cash flow neutral, but I would like to figure out how to get out of this to start getting into it, then let's run those math. Essentially, it's what's my income? What are my expenses now? How much of those expenses are debts that I can pay off and eliminate? And if that's a large enough savings, then it might be a good idea to look into a product like this. Now, if it's, hey, I'm looking at starting a business, or I just started a business last week. Okay, well, we still have to qualify off standard qualifications. We need to see a history of you running your own business and so on, just like any other mortgage product. But really getting a good understanding of your finances, which I feel like everybody says, oh, I have an understanding of my finances, but it's all kind of this mental accounting. Oh, I know what I spend my money on. I went to the grocery store here. I did that. Oh, I bought this thing, that. But they're not
Uh-huh.
really looking into how much did I save last month? What's the exact dollar that I brought in last month? And what are the exact expenses? Now, sure, there might be one-time expenses. Remove those because you're not going to need to buy a new couch every single month. But let's take a look at your profile. That's probably the first and highest and best use of determining if this may make sense.
Yeah, yeah. And the nice thing about one of the nice benefits of the all-in-one loan is it eliminates your mortgage payment if you're doing a refi, which for many people is their largest monthly expense. So when we look at your cash flow situation, we're looking at your cash flow, not including your mortgage payment. So obviously that gives you more additional cash flow. And I want to point out that the all-in-one loan is not a get out of jail free card. If you are someone who is struggling with debt, especially toxic debt, we need to understand why do you have all of this debt? Because this is a strategy that requires more financial discipline than other strategies like basic strategies like debt snowball, which by the way, you can do debt snowball with a first lien HELOC if you wanted to, but you need to demonstrate that you are able to save money and that you are able to resist the temptation to spend money and go into debt.
Yeah.
So if you're someone who's really struggling with getting your cash flow positive and paying off debts, I would be hesitant to recommend this strategy for you. We can talk about it, but you've got to have financial discipline or this is just going to make a bad situation worse. If you're looking for a get out of jail free card where you can start paying your debts off without reducing your lifestyle, this is not it. This is not it. You know, unfortunately, I have people who talk to me about this and, you know, it's always, yeah, we're going to pay off debt. But, it was my 50th birthday. So we went to Mexico and yeah, I bought a new car because I needed a new car. And it's like, okay, so you're not serious about this. Like you
Yeah.
didn't know you didn't need a new car. In fact, you don't even need the car that you have. And yes, I know it was your
Yeah.
50th birthday. You didn't need to spend all this money. So,
Exactly.
this is not going to fix that kind of a problem. It will not. It will make it worse. And of course, what's going to happen is those people are not going to qualify. Probably their debt to income ratio will disqualify them from this product. So so along those lines, let me ask you this, Harrison, who should not be looking for a first lien HELOC? In what scenario would this not apply?
Yeah, I mean, in many instances, I'll kind of walk you through the requirements to qualify because
Okay.
anybody that doesn't fit these probably may not be in the right position to get into this product. So
Okay.
for the most part, we want the individual to have 20% down. On a primary residence, there is a 10% down option, but there's just higher costs. And in many instances, I personally don't think it makes the most amount of sense to do that unless if there's a, oh, I'm going to sell this property over here and I don't really care about the upfront cost because I'm going to pay this down like crazy. Okay, there's a variation that you can make an argument there. We need 700 credit scores for a primary residence. We need to see debt to income ratios below 43%, but we would prefer to see them below 40. And the reason of the distinction is that if your debt to income is below 40, we have to have a reserve component on either aspect. If it's below 40, outside of your down payment, we need 10% of your line of credit in reserves. So if you have a $50,000 line of credit, we need $50,000 somewhere else above and beyond your down
Sorry. So I
payment.
think you meant to say if you have a $500,000 line of credit, you need 50,000 in
Yes,
reserves,
yes,
right?
my apologies.
Yeah.
Yep.
Yeah.
And if it if your debt to income is between 40 and 43, then we need 15% in reserves or $75,000 somewhere else, checking, savings, stocks, bonds, 401k, cash value, whole life, IRA, etc. It has to be accessible. And there can't, in many instances, be a loan on your 401k. A lot of people say, well, I have a loan on it. Most 401ks only allow for one loan. And if they do allow for a second loan, it's at a much reduced balance, which then we may not be able to have enough in reserves.
Right. Right. Okay. And then I think also there can be challenges with, we mentioned real estate investors because they may make a lot of income, but on paper they're not showing enough to qualify. And then I think also with business owners too. So if you're thinking of starting a business, you probably want to square this away first. So if you have W-2 income today, it's easier to qualify. Once you start a business and leave your W-2 job, standard bank practices, you need to have 2 years of income that you're showing in order to
Mhm.
qualify, and they're going to average those 2 years to get your income level, because sometimes in business in the early years you don't make much, right? And if your second year is lower, they'll take the second year only, right? So
Exactly.
you can say how much you made, but maybe you made $150,000 in year 2, but in year 1 of your business, maybe you only made 30,000 because you were getting it started. Well, they're going to take the average of those two. So just keep in mind, again, like I said before, do not take for granted your ability to get access to this product. So
Certainly.
you always want to try to secure the debt instruments before you actually need them so that they're available to you when you need them, right? So very good, Harrison. Anything you want to leave our audience with in closing on the all-in-one loan?
No, I mean, obviously, if you have any questions, certainly feel free to reach out to myself. Obviously, I think Logan will put some of this into the description, but to reach out to me, my email is harrison@cmgfi.com. And my personal cell phone number is 925-785-6828. If I don't answer, leave me a voicemail. Let us know where you came from. We'll obviously reach back out to you, myself, or somebody on my team, and we'll just make sure we can walk you through it. Hey, does this make sense or doesn't it make sense? And it's a pretty simple calculation. By no means do we ever want to put somebody into a product like this that it doesn't make sense for, but we will provide you with the guidance on, hey, look, this is where you're at now, but you just need to be here. Here's the steps and time frame that it'll take for you to get to this, and we'll just walk you through everything.
Excellent. Excellent. Yep. I think do your own research. Definitely. There's plenty of information out there, but don't think that you're an expert either. So if you come and talk to me, hopefully you'll be open to a little bit of guidance to understand a bit more about it and see if it makes sense for your specific situation, because it doesn't make sense for everybody. And so it's not just qualifying from a credit, income, finance standpoint. That's of course required, but also making sure that you have the knowledge and the right psychology to actually execute on this strategy, because as we keep saying, this is not for everybody. It's not for
Yes.
everybody for financial reasons, and it's not for everybody for psychological reasons too. You know. So some people just don't have the right emotional and psychological makeup to do this, and that's perfectly fine. There's no judgment at all. It is what it is. It's not for everyone. Well, thanks so much for your time, Harrison. We greatly
Yeah, man,
appreciate it. We
appreciate
will
you.
look forward to the next one.
Talk. Thank you, guys.